Hello, class, and welcome to our fifth lecture series on international finance. And I'm your instructor, Dr. Jamel. Okay, so we finished our discussion on chapter 3, international financial markets, and we talked about wait a second, let me go through here. Yes. So we ended our discussion on origin and development of the markets, and then we talked about that all the dollars that are deposited in the banks of Europe or in Europe and other continents, we call them euro dollars or euro currency. Okay, the other one we talked about the Asian money market, in which the dollars that are deposited in Asian markets, we call those Asian dollar market. Okay, so euro dollar is called the dollar that is outside in any country, right? And if we talk about Asian dollar market, in which then we are talking about either Singapore or other Hong Kong market. And nowadays we also, because this book is a little bit old and we have a new development here, Shanghai Stock Exchange and Shenzhen Stock Exchange as well, because Hong Kong Stock Exchange and Shanghai Stock Exchange along with the Shenzhen, they are collaborating as one. So in future you will be you would be denoting the Asian dollar market as Chinese Stock Exchange, because Hong Kong is now a part of China. Now, the money market interest rate among currencies. Here we go. So the money market interest rates in a particular country are dependent on demand for short-term funds by the borrowers relative to supply of the available of the short-term funds. So generally, the interest rate is lower for short term, because companies and individuals who need money for short term, of course, there would be lower interest rate. Why? Because default risk in long term is high, short term is very low. Plus inflation in long run may be high or may be low, but we don't know, right? But in short term, we can predict, okay, inflation gonna up or gonna down. So default risk, liquidity premium risk is gonna be high, or interest rate risk is gonna be high long run rather than short run. Then why in some countries short term interest rate is higher? It's because in some countries the companies, they demand for short term more. So if the demand for short term funds are increased, so that the price, so look at that. So we talked about it in our previous classes in economics. So this is supply, this is demand. If this is funds, fund supply, funds demand, and here are rates. The price of funds are called interest. So remember, if demand increase, shift to the right, it means interest rate is now increase, right? So that concept doesn't necessarily mean that, the concept is there that short-term interest rates are lower as compared to long run. Why? Because in long run, default risk is higher, liquidity premium risk is higher, interest rate risk is higher, right? But here in short run, these are not very much, higher. So it should be lower. But in some countries, short-term interest rate is higher. Why? Because of demand and supply. Demand and supply of funds. If in a country, people or the businesses require more short-term loans, then short-term interest rate is increased. So money market rates vary due to differences in interaction of total supply of short-term funds in a specific country versus total demand for short-term funds. So, like I told you here, again, so this is the funds, and here are the rates. So you can say that this is short-term funds. Short-term funds supply. Who supply? General public save save their funds to the banks, and banks grant short-term loans. And who require, for example, businesses? The demand. What if the businesses require more short-term loans? Demand shift to the right. Shift to the right mean, so right now the interest rate is here, and these are the quantity of funds. But what happened here? Due to increase in demand by the companies, now new equilibrium is when short-term interest rates are higher. So me, person like me or the common people, they will save more. They will reduce their consumption. They will save more money with the banks because interest rate is higher, and they want to enjoy more interest on their savings. So interest rate increase from I1 to I2. That's what they are saying. So any question regarding the short-term interest rates, why it is high? Tiffany? Claire?
Yes.
Rougier? Sufyan? Lancelot? Oliver? Dion?
Yes.
Claire?
Yes.
Okay, now global integration of money market interest rates. So money market rates means short-term interest rate. Money market is always that market in which short-term funds are traded. We talked about in our last lecture. So money market interest rates among countries tend to be highly correlated over time. So if short-term funds are higher in Mexico, it is also higher in United States as well. Why? Because now the economy has become global village. So if Mexican firms require more short-term loans, they will ask loan from where it is cheaper, right? If in Mexico interest rates are high, right? Short-term interest rates, so they will go to the US and require short-term loans. And what happened? Demand of funds in US, short-term funds will be higher in US as well. So interest rates start rising in US as well. Or if US companies require more short-term loans, and in Mexico it is right now cheaper, so they will buy more loans from Mexico. And what happened? Demand for short-term loans in Mexico start rising. Similarly, demand shift to the right, like in our previous slide. Short-term interest rates are increasing. So that's why there is a high correlation over time between countries. So when economies condition weakens, number two, first of all, they are highly correlated. And number two, when economic condition weakens, the corporate need for liquidity declines, and corporation reduce the amount of short-term funds they wish to borrow, interest rate for short term started to decline, right? So company, if economic conditions start weakening, so what happened? Businesses, they were skeptical about their sales. They will decrease their sales projections. And when they decrease their sales projection, of course, they need less employment, right? So they will fire some people. They will close down the extra shifts. So they will require less funds for short-term operations. So in that case, short-term funds demand decreases. When short-term funds demand decreases, right now, this is supply and this is demand, and we are in equilibrium. This is quantity of funds, and this is interest rate price of the funds. So what happened here? Economic condition weakens, it causes demand to decrease. When demand to decrease, we have a new interest rate which is lower, and available funds are also lower. Why? Because people now will take out their money from the bank because interest rate is very low, and maybe they spend somewhere where they will find more player. Maybe they will buy a car or start their own business or consume more or whatsoever their needs are, right? Because interest rate is lower, so it's worth less to keep their money with the banks. Here we go. So when economic conditions strengthens, what happens? The next year, businesses' projection about sales are increased. When sales are increased, so they need more workers to make those products. So they need extra shifts to work, or they need to hire more workers, and they need more funds. So demand for short-term funds, what happened? Increase, which ultimately push the economy to increase short-term interest rate, right? So what do we mean by additional liquidity here in international financial concepts? More cash, right? So are we clear on these 3 points? Global integration of money market interest rates. So interest rates are highly correlated between countries as well, because we know that previous chapter we talked about international flow of funds. The funds will move from that country which offers less interest rate to that country which offers high interest rate, right? So Tiffany, Oliver, Sufyan, Lancelot, Ruchie, understand?
Yes.
Good. Guys, if
Yes.
you listen, please ask, okay? Now, international credit market. So MNCs sometimes obtain medium-term funds. So previously, we just have 2 categories, short-term, long-term. Short-term, when requirement of the funds are for up to 1 year, less than or equal to 1 year. But medium-term loans are 1 to below 3 years. And more than 3 years, it's long-term loans. So MNCs require medium-term loans. So what they happen? So medium-term funds through term loans from local institutions or through the issuance